first, before I get into my bio and what Manhattan Street Capital does briefly, I'll give you a legal disclaimer. I am not, and my company is not, a underwriter or a broker-dealer, and I'm not a valuation professional, and I am not an attorney. So I'm talking about a lot of things in the Reg A Plus process, which is a very regulated space, but I'm talking about them in ways to help you guys, not pretending to be anything that I am not. And partly, in addition to this, I'd like you to read the disclaimer, which we posted in the chat, so you can see, you know, further. It's important that you read that because I don't want to mislead anyone in any way, shape, or form. Okay, now I'll go on to who the heck am I? So my name is Rod Turner. I'm the founder and CEO of Manhattan Street Capital. I have, in terms of background, it's relevant. I come from the tech background. I started out as an engineer. I moved into startup companies at the age of 24. I've done 6 prior successful startup companies with liquid outcomes, 2 of which we took to the NASDAQ. One of them was Ashton Tate, for those of you who are of my vintage, you might remember it, D-Base 2. And the second one was Symantec, the Norton antivirus company, which more of you may recognize. Inside Symantec, I drove the largest mergers and acquisitions. My team introduced the Norton antivirus and made it the market-leading antivirus of that ilk in that time. And I've done numerous mergers and acquisitions, and I've also been on the receiving end of having my companies acquired. I formed a venture capital firm called Irvine Ventures with a good friend of mine, Safi Qureshi from AST Computers, in the late 90s. And I've done a lot of angel investing and raised money from numerous blue chip venture capital firms in one or other form of companies that I've worked with. So I have a lot of relevant experience, and then I got into Reg A Plus, courtesy of launching Manhattan Street Capital. I launched the company, I started the company in April 2015, just before Reg A Plus went live. And we were the first dedicated Reg A Plus funding platform when we went live in May of 2015, just before Reg A Plus went effective at the end of June of 2015. So we've been at this for a little bit more than 5 years. We were initially called Fund Athena because I wanted to focus on the fact that women can't get capital, which was nice, but a bad idea because there weren't enough companies that were aware of Reg A Plus at all. So narrowing it down to a subset of a tiny, tiny market was not working. So we pivoted, changed the name to Manhattan Street Capital in October of 2015. And since then, that's been our brand name. So I'll shut up about the company in a minute. We do 2 things. We are a platform for fundraising of Reg D, but mostly Reg A Plus offerings. And we're a consulting project management company, advisory company, because we're selective and we help the companies that we work with in a very proactive manner by bringing in all the right service providers and helping advise them as to what to do, how to do it, front end loaded throughout the whole journey and through to the back end and after the back end, after the completion. Okay, enough about me. I will now I'll restate the agenda real briefly, and then I'll get into presenting. So I'm going to touch on what Reg A Plus is, the advantages of it over a traditional IPO, talk about the schedule. We'll get into underwriter involvement, marketing and costs and ongoing costs, size of raise, the IPOs to date and how they've done, what we've learned from them, post-offering liquidity for companies that don't want to do an IPO, mistakes to avoid, and questions and answers. That's the agenda for today. Hopefully this is the correct webinar and that you're in the right place. We are not going to be discussing the weather in the UK, even though I obviously come from the UK, or blue clothing, because evidently that might be interesting to, you know, a microscopic audience, but not what we hear about today, even though I'm wearing blue clothing. Okay, so What is Reg A Plus? It is a public offering by the SEC's determination, not an initial public offering unless you list. Anyone can invest anywhere in the world except those few problem countries. The investors are deemed liquid by the SEC. That's a different thing than having a trading place, which we'll get into later. But they are considered liquid securities by the SEC. Anyone, anywhere can invest regardless of wealth level. If they're accredited, they're not limited in any way how much they invest. If they are not accredited, they're limited to 10% of their net worth or their annual income. And they self-state. We don't have to prove that. They don't have to prove that. Tier 2 is the way to go. And if you do a tier 2, then you have to start off with an audit that covers the last 2 years if your company existed that long. Or if your company existed 4 weeks, then you have a US GAAP level audit for 4 weeks, which is obviously less expensive to produce. The people that invest in Reg A Pluses online are generally optimists, quite different than accredited investors. We do get some accredited investors, mostly in real estate transactions. We have two sweet spots, though, outside of real estate. One is what I said, optimists, and I'll get into that more in a moment. And the other is people that are almost accredited. If we see someone investing 30K in a Reg A Plus, they're almost always someone who is wealthy, almost an accredited investor, but not quite. They're a sweet spot. The main sweet spot, though, for Reg A Plus, in general terms, and not so much in real estate, the investor mix is more normal, more representative of a broad array. But in non-real estate offerings, most of the investors are Main Street folks, regular people that aren't accredited, not close. They have disposable income. They're investing because perhaps they need a decent dividend return, not that's so hard to find. Some of our offerings are doing that. Or because they are buying ownership in a company they believe is going to make them a millionaire, even though we don't say that. They are looking at a company and believing strongly that it's going to make them a fortune over time. Or they're doing it because they want the company to do what it does. They're voting with their feet to support it, to make it succeed. A biotech company doing an Alzheimer's treatment, a cancer treatment, if it's the right cancer particularly, things of that nature make biotech a really wonderful fit in many cases for Reg A Plus. So if they care about it, that's enough in many cases. If it's serious enough need, pain treatment, we did a biotech offering where they raised money at the least expensive we've done so far, where they were spending $3.30 per $100 raised via social media advertising, which is a thing of beauty because it's a non-addictive painkiller, that non-addictive, non-opioid painkiller satisfying a really serious need that many people are fully aware of, and they want to support that. And it's a good investment in many people's eyes. I've got to be careful what I say because I'm not allowed to, as a non-broker, I'm not allowed to promote the companies themselves. That offering is behind us. It was a great success. Okay, so these folks are optimists. To give you an idea, 60% of the money coming in these days on our platform is from people investing via their smartphone. And out of 100 people who will invest in a Reg A Plus over time, 1 or 2 of them will invest on their first visit. You know when that's happening, they're an optimistic group, right? You have to be very careful to make sure that they're fully informed and not assuming too much good stuff. There you go. I touched on the reasons they invest as well. Okay, so why? I'll get into costs and things later. I didn't cover those just now in the Reg A Plus bit, but we'll get to that. So then, why use a Reg A Plus offering prior to do an IPO? These, what's the reason for it? So these are the primary reasons. If you are in the case where a company can make it an S1 IPO or a Reg A plus IPO because it's strong enough to make the choice, then these are the advantages. Through the Reg A plus, you'll get lots and lots of investors, so you'll have genuine liquidity when you list. Genuine liquidity is very valuable to help maintain the share price, and it's what the markets want. It's very beneficial to you as a listed company. If you do a Reg A plus method, then you're paying much less money for your audit and much less money for the legal filing fees, because this is not yet an IPO. This is a Reg A plus. So your fees are far lower, especially for companies that have a long history. The 2 years of audit could be expensive. You'd rather not do that with a PCAOB audit right now. It's going to cost a lot more money. You do a US GAAP level audit for the Reg A plus, and that's sufficient to go public with, right? And then you get, subsequent to listing, you add in the PCAOB audit for the next quarter, and you don't need to go get an expensive attorney to list because you already did that via the Reg A plus. So those are significant reasons. Another very significant reason is that sometimes people do an S1 IPO and they can't raise quite enough money to list. Maybe they got to raise 12 million to list and they reach 10 or 9. And for one reason or another, the underwriter and the company shut it down. And guess what? Guess how much money they raised? Zero. The big zero. They spent an awful lot of money on those expenses, filing the S1, et cetera, broker-dealer, underwriter fees, et cetera, non-refundable, and have no positive money in the bank at all. Not a fun place. And the egg on the face, right? So a Reg A plus, however, if it had the same outcome with the same intent, we would be raising money online in the Reg A plus beforehand. So, and you would be able to close that money as you go. You would not have to give it all up and give it back. So you actually do a capital raise, and it's not a complete waste of money. It's a good deal. You didn't list, okay. You've got options. You can come back later. You can list on a lower market, but at least raise the damn money, right? So that's a significant advantage, pardon me swearing. I'm British, and if I let myself go, I'll be swearing, and you know, you guys would either enjoy it or hate it, so I've got to be careful with that. There are another set of reasons why companies use Reg A plus to IPO. We are working with some companies right now in this situation where they're not quite strong enough to do an IPO right now. They aren't. But if we raise $14 million in a Reg A plus, then they'll be strong enough. And we'll get the underwriter support that we need to list them. The fact of the matter is that the underwriters as a space, underwriters have been going through a very nice period of time where they can very easily conduct offerings, and they're getting picky and they're getting demanding. And so a good company can go to the right underwriters and be told, yeah, good, okay, so get the first 8 million in, and then we can go, you know, then we can go with this. And others might be approaching the wrong underwriter and get told, yeah, pay 45K, commit to these commissions, and then nothing happens because it's not really a strong enough company. I'm not saying there are many underwriters that would do that. We have a service where we find the right underwriters for you, and obviously we know who they are. But my point is, there are companies that are really interesting that aren't quite interesting enough to get the underwriter support to do an S1 IPO. We build the momentum and awareness, and especially the amount of money in the bank and the numerical investor account via the Reg A plus, go back to those same underwriters further in the journey. Oh yeah, now it's a lot easier story, right? It's already a successful offering. It's already a successful raise. If it has the right characteristics now, we can take the company public and be very pleased that we did it. So that sequence of events is one where, you know, we have about 3 companies working with us right now with that kind of plan in mind. They aren't all signed up yet, I should say, because they aren't all signed up yet. Bear with me. My phone is still ringing in my ear, which is okay. Even you aren't hearing the ring. Okay, so, and by the way, as we go along here, you're welcome to write questions in that I'll do my best to answer at the end, all right? Advances, yeah, we'll get into the questions and answers at the end, otherwise I'll lose my flow, and God knows what would happen. You know, I could be going outside and jumping in a kayak or something, which would be of no use to anybody. Okay, so for the companies that aren't basically appealing enough to do any kind of IPO right now to the NASDAQ, then this is a very good way to go, and we can change the nature of the beast to where they can actually list, right? So that's a good way to go, and it's very appropriate when it is appropriate. Okay, check my notes here. Yeah, the company gets more attractive as it goes, basically. One more advantage to doing a Reg A plus en route to an IPO that applies to both companies that don't have to do it via Reg A plus and those that do, is that we're building brand ambassadors, right? Everyone that becomes a part of the company is going to be, because they like it and they wouldn't have invested otherwise, they're going to be out there talking the talk and telling their buddies about how marvelous it is, which is a good thing for sales. And if it's something that's obviously potentially very good, depending on the nature of the product from the company. Okay, now we move on to the next segment. Reg A plus IPO schedule. So essentially there are two schedules, right? For companies that could do it anyway and have a large, particularly if they have a large fan base or a large customer list, then in that particular case, we can do what we did with Archimoto, right? Archimoto had WR Hambrecht as their underwriter and us as their funding platform, and a large audience of enthusiasts in social media that they had built over time for their three-wheeler electric car. So they were able to do pretty nifty stuff very quickly, unusually quickly. They raised $4 million online from retail investors at an average investment amount of about $2,000 in their Reg A plus with us. And they raised $15.5 million with the Hambrecht underwriter doing the normal thing for an IPO. And then they listed. And they've actually, their stock price hasn't done great, but it's now doing nicely. It's starting to recover because they were a long way away from having a car to produce, and it's tough being out there flapping in the breeze without too many major news announcements about how many cars you just sold, et cetera, et cetera. But the point being, with a large fan base, you can raise $4 million online in a Reg A plus, which is exactly what we did with them. But in a more general case where there isn't a fan base, then even in that case, if the company chooses to take, if the company is strong enough to do their own IPO, but they choose to raise money on, what I mean, if they're strong enough to do an S1 IPO, but they choose to do a Reg A plus IPO for the reasons I outlined, but they don't have a large fan base, then we're not really going to raise $4 million in 4 weeks online, because you just can't get the marketing, the advertising working efficiently, cost efficiently that fast. It just doesn't happen. You can spend megabucks inefficiently and raise a lot of money, but not 4 million in 4 weeks, okay? So in that more realistic scenario, then let's say that the company needs to raise $8 million online to fit with the expectations that they've already negotiated with, or we've helped them negotiate with the underwriter. In that case, then we get the 8 million as fast as we can whilst retaining efficiency in the process, right? So that 8 million might take 3 months to raise. It might take 4 months to raise. Something of that ilk is reasonable. And then they go to the underwriter. We're in constant communication anyway, and they do their bit, which takes 2.5 weeks. And now we're listed, right? And the way it works in a Reg A plus IPO is post-listing, there is a series of filings that upgrade the company to full S1 level. But they're easy filings, and the Reg A plus attorney that got you into the deal in the first place that we brought you to can do all of that work, right? And it isn't heinously expensive. And you do have to get a PCA or B audit for the first quarter subsequent to listing, as you would expect. but nothing. Now you're public, now you're listed. Now the issue, of course, is having a series of good news announcements to protect your share price from naked shorting, which stockbrokers are allowed to do with gay abandon. So it's not just enough to do an offering and be a successful company. You have to have conservative financial management in place, so you manage your expense level, and serious reserve making, which a great CFO will do, and I could train your people on this because I've done this stuff if needed. It's a cultural thing, right? To be ready to list and to be ready to perform where your company stock price does well afterwards. There's a heck of a lot of conservatism, predictability, managed predictability by the CFO, managed communication to the financial audiences, and news announcements, good news announcements, because when the broker dealers / stockbrokers out there are looking for companies to put a naked short on because they can, to make a bloody fortune, to make a fortune at your expense, if you make a series of regular announcements that are newsworthy and genuinely strong enough to bolster interest in the stock and in the company, they're going to go somewhere else, right? Not every company has that ability because of the facts. So bear that in mind when you're thinking about if you want to list, because if you are naked and flapping in the breeze and no news announcements coming for 2 years, the likelihood is your stock will go down and down and down until it's a penny stock or some horrific thing of that ilk, and then you'll be wondering, was it a good idea to do this? Okay, that's a whole story unto itself, which I'm happy to train you guys on if you're doing that path. We did it right. We did it wrong on my first IPO. I was VP of sales for that one, and the CEO is a great guy, real entrepreneur, but he shot from the hip. He gave the analyst community numbers that were higher than our internal plans, things of that ilk that really made life very difficult. I was running sales, so I had to live up to these standards that weren't part of our plan. But Symantec we did right. The first 16 quarters post listing, we delivered better than our public expectations. We beat the market expectations. 16 quarters. So our stock did wonderfully, lots of institutional investment. We were a darling of Wall Street, right? That's not casual, that's not random, it has to be worked on, it's a serious effort. Okay, so then evidently, it should be evident that if we're doing a raise for a company that isn't quite attractive enough to get underwriter support to do a NASDAQ listing, then we raise the money, and we raise the money over time. When we've got it, we do it, right? You can raise typically 12 million, 14 million is enough to list on the NASDAQ. Can be less depending on the shareholder mix now, and market value, and so forth and so on. But we can do that and expect it to take some time. And frankly, the smart way then is that when we're attractive, then I go to bat on your behalf, assuming you're working with me, to solicit interest from the right broker underwriters, and we pull together. Obviously, I pull together a pitch with you guys. We pull together a pitch that's a good pitch on the company. I approach the underwriters. We get their response, and if it's positive, which it'll be because we're doing it at the right time in the right way at that point, then you and we negotiate a deal, and that's going to cost 40K, 45K upfront, typically to the underwriter, to the lead underwriter, and 8% commissions, 8.5% commissions, plus warrants of the same face value to get them on board. But you only do that at the end. You don't do that prior to. You do it when we are ready, right? They'll want some payment on the money that's raised on the platform after they're involved. You don't want to be paying them that money prior to. And now is when we're attractive. So that's the sequence of events that makes sense, I'm sure. It might take 9 months to get to the point where we're compellingly, obviously ready out of the 12 months that you're allowed to raise money in the Reg A+. And then go do it, right? The underwritten part is straightforward, and it takes 2.5 weeks to raise the money. That's their bit. It's very fast. It's straightforward. Okay, just checking to see I've covered the things I wanted to cover here. Yeah, there's other things we'll get into, but they're going to be coming up automatically here. Underwriters. How do we deal with underwriters? Well, I just gave you a preview right there. So I can't look at the questions. I've got to do that later, and I'm happy to, and I will. I can't answer every question. If there's too many, I'll answer the ones that I can add the most value to if there's too many. So how are we doing on time? Oh, we're doing okay. So we know who the underwriters are that like Reg A Plus and that are good to work with. So that part's not a problem. And we can go, let's say that it's the right time for you to find out if we can put together an IPO with those underwriters or not. So then I help you, as I said earlier, put together a presentation that's going to fly. And then I go to bat engaging with those folks. We get phone calls set up and move the ball forward. And then I help you negotiate a fair deal with those underwriters. And, you know, it's typically going to be a lead underwriter and two more to make 3 as the leading group that will pull together a syndicate that will raise the money. And of course, there has to be money left to raise. Otherwise, why the hell would we do this? I mean, for them, they're not interested they're not interested unless they can make money. You do have the option to do a direct listing, which nobody's done yet via a Reg A Plus. I'm looking forward to doing the first of those and then more. You can take that approach. So that's an option too, where you don't use an underwriter because we meet all of the necessary requirements for listing without one. That's a very doable thing, but it hasn't been done yet. Okay? Okay. I already touched on the costs, how it works. They build a syndicate. The syndicate is essentially the commission that is paid to the lead underwriters, the group of 3 typically, is 8.5% or so. And they will assemble a syndicate that get paid 5 or 6% out of that, and the remainder goes to them, right? So they'll do their own work with their own clientele, and they'll be bringing together a syndicate of broker dealers under them who will be, my son wants my attention, which is not cool in the middle of a webinar, who will be, so the sub dealers, if you will, the syndicate members will be making enough money to make it worth their while. And that's why the 8.5% has to be that scale. Otherwise there isn't enough money to go around. Okay. Okay, moving on. We will be sending out a recording of this webinar because we're recording it. Sometimes I've screwed up and not recorded it, but we have recorded this one. We are recording this one. So there'll be a recording you'll be able to access with a clickable index, so you can skip the boring bits and go to the bits you care about. It'll be posted on our blog post. When it's done, it'll be done within a week, you know, less than a week from today. Okay, now marketing and costs, marketing costs and cost in general. So primarily marketing, there's an exception. The exception is you got a large fan base or you got a large customer base that love you, then marketing is inexpensive and it's all focused on making a compelling offering page, designing marvelous email messages to go to that list, and raising money from them, or if it's social media, designing the right communication to bring them in. You can raise all the money that way for virtually free, except for the preparation costs in that lovely scenario. One company that I'm aware of did just that. This company, VidAngel, raised $10 million, their maximum, in 12 days live to investors. They did have a break of about 10 days because they had a problem, which they had to deal with the problem states, they had to solve that problem, and then they went live again. But they raised that money by simply emailing their 30,000 happiest customers. That's all they did. No advertising expense of any significance, few social media organic posts, beautiful offering page, and a well-pitched message. $10 million in 12 days live is a record to my knowledge, and more power to them. The more companies we see like that, they're super easy to do, of course. In the normal mode, where we don't have enough of a customer base or a fan base, the issuer, the company does not, then we need to build it from scratch, right? So of course, if you're working with us, then we will be emailing our member base and telling them how marvelous it is, etc., in the ways that we're allowed to do that, and sharing in our social media. We've got about 150,000 person social media fan base, but you're really going to raise the majority of the money from reach out advertising in social media, drawing in investors. And it's all about targeting, tuning, testing, and adjusting. And of course, up front, making sure that what is being sold to these investors is appealing. So one of our primary role at the beginning of discussions with companies is to figure out what the company does. You know, obviously it has to be a great company and all those obvious things, but how are we going to make this appealing to the investors? What is it, what should it be? What should the offering be? So we can't tell our clients what they should be. We can tell them what won't work. We can tell them what will have appeal to the audiences that we market to. So we do that. So by helping in that manner, then you're doing an offering you should do, because I don't want you to do it at all if it's going to fail. And your the messaging and targeting and so forth starts off, because we've thought about this a great deal, right? With appropriate test messages, test advertising, test targeting. And in month one, literally, you'll be spending $10,000 on advertising, just the advertising part. And so far, in every case, we've raised 3 to 5 times that much money in the first month, which is heinously inefficient, but not bad for the first month when we know we don't know what we're doing, right? So that's the way it works logistically and cost-wise for the marketing. By the way, since COVID hit, and since this, when it was the stock market falling apart period, then costs went up 25%. But after that, they recovered, and now our company's cost of advertising to bring in investors is 10% lower than before COVID. Just so you're aware, so I don't forget to tell you that. So month 2 is better than month 1, right? And if we're lucky, it's really a lot better. If we're not, then it's better, and I'm recommending, and the agency is recommending, we bring in the agency. We manage them jointly with you. They're recommending that, we're recommending that maybe you double spend or treble the spend in month 2, depending on the efficiency we reached at the exit point from month 1, right? This stuff's adjustable at the drop of a hat day by day, the spend level on social media. So that's the nature of the beast, and we're constantly looking for higher and higher efficiency. And then as we get to the point that the acceptable efficiency is reached, then we encourage you to spend a lot more money and raise a lot more money fast. But that won't happen in the first 2 months. It takes a lot of testing and tuning and adjusting. As the offering is continuing, we're assembling a list of people that gave us their email to see the investment page who like it. And I forgot something I was going to mention earlier. 60% of these investors invest via smartphone. Did I say that? Anyway, now I've said it twice or I've said it once. Either one is enough. So it's a build, right? We're building a list of email people, email recipients. We build a relationship to them. We regularly email them probably 3 times a week with interesting messaging updates about the company. If there's a share price change, we're emailing them about that. You name it. We are building an ever bigger list, which makes the cost of marketing gradually lower. People who put in a test investment early come back and put in a bigger one later. Then they come back in from their managed IRA and put in a much bigger one. That sort of sequence of events occurs. Okay, so marketing, advertising expense, we want to drive it as low as we possibly can, but you should assume, and there's another factor, which is once it starts to really work well and the efficiency is good, then when you step up the spend, the cost per investor goes up, because the channels we use, primarily Facebook, Instagram, they know they're doing well, and we've stepped up the spend to megabucks, so they jack up the price. right? The efficiency drops off some for that. So being impatient is expensive. Managing that, doing some things to try and game their system to give us the better rates again, which we do, helps. But the cost of raise, you should expect marketing when it's all said and done to be, the lowest we've done is $3.30, 3.3%, right? On one, that's our lowest, but I wouldn't have you expecting that. I think you should expect 6%, 7%, maybe lower. We'll do our best to keep bringing that down, but that's the likely cost. It's the single biggest expense in your Reg A Plus offering with us, because we're not a broker dealer. We don't charge a commission, and our fees are very modest. Okay, so I'm inadvertently or deliberately selling you on my company, which isn't the whole reason we're here, is it, guys? But let's see, costs. Okay, now going over to costs, the rest of them too. The least expensive, assuming that you don't have a large captive audience to go to, let's assume that. The least expensive way to reach the point that the offering is qualified by the SEC and it's ready to go live and we're raising money is about $150,000. And that assumes a simple audit, okay? We can get it a little lower if we go looking for a less expensive attorney, but that includes everything. 150K, that's the least it can be. There are lots of things we can do to raise it that I don't recommend, but you know, you should assume that's the least expensive and have more money on hand just in case. And that assumes some prudent moves on your part, which I'll get into later, you know, mistakes to avoid. Then after that's happened, we're raising money, we'll be cash flow positive from the raise relatively soon, relatively quickly as we move forward, when the offering is structured properly such that you have a minimum raise, you don't have an escrow with any amount of money that you need to close first. And when you, because we're coaching you and the attorney is coaching you, when you write the offering document in such a way that you can use the proceeds to spend on the offering expenses. So in that context, then cash flow wise, it was the upfront money, unless we get really unlucky and have terrible investment returns for the first few months, in which cases there are other expenses, but it's not going to be terribly expensive, but they do exist. So I gave you the upfront cost. That's it. I reckon if you're doing a $12 million raise, that my guidance to you is that the cash cost is going to be about 12% plus warrants. Not very many warrants or more warrants, depending on the degree of broker-dealer involvement. There are 7 problem states that require either you and the securities attorney with our coaching to go to those states to get permission to raise money in them. Really, it's just Florida and Texas that matter. And you can do that with the securities attorney. But frankly, Florida is really, really slow and there's risk. You know, you could enter on that. You could, by doing it in this manner, you don't need a broker-dealer charging any fees on the offering. So that will get you Texas. It might or might not get you Florida in a timely manner. The alternative is to sign up. The broker-dealer we recommend, it charges 1%. An upfront fee of the list upfront fee is 25K, but that can sometimes be negotiated lower, and there's an 8K FINRA fee. That's an example of something you don't need instantly when we just went live, because we're only spending tiny amounts of money. You can add it a bit later when there's been some positive cash flow on the raise, so you avoid adding the cost, the upfront cost of the broker, and you avoid paying 1% when you don't need it yet, right? We have a way within our website to capture those people from the problem states and register who they are. And you can go back to them to raise the money then when the solution is in place by whichever means it's made. Okay, so that covered the cost in a reasonable manner. Minimum raise should be 0 unless you're buying an asset and it's the reason for the raise. That's horrible because you've got to fund all of the offering expenses out of your pocket or somebody else's pocket until you hit the minimum. It's horrible, so try and avoid that. Maximum raise is 50 mil today. It's possible the SEC would raise it to 75. I think they may do that, but we won't know until we know. 50 mil is enough to do a lot of good. I'll get back to that topic in a bit. Looking at the Reg A plus IPOs to date, I haven't got details on all of them, and I didn't dwell on the failed ones. You know, there are some that have failed, but then that's true of S1 IPO companies too, right? I haven't got a study of the S1 IPO companies that went out at the same time and how many of those have, when I say failed, you know, had their stock price go down a lot. So I'm going to talk about the better ones because I don't want to spend too long on this subject. Chicken Soup for the Soul went out at $12 a share. They're now up to $14 a share. I have some ownership. I own some shares in Chicken Soup for the Soul. I should disclose that. Akimoto went out. I think they listed, I don't remember the list price now, frankly. They went down. They went down quite a lot and they've been recovering. So maybe they went out at $10 a share. That's kind of what my memory tells me. When I looked on my app on my phone, I couldn't quickly get the listing price, and I didn't remember it and didn't make the time to get it from my own documentation. Anyway, so I think they went out at 10. They've been down a lot and they've come back up because they're getting real, they're shipping cars. It's, you know, now they have stuff to announce, right? It's a lot easier life when you've got material revenues coming in and so forth. It's a neat company with a neat car. So those are the two ones that I like most. FAT Brands, FAT, Fat Burger, they had a very tough offering. They ended only, they only listed on the OTC because their offering failed, which they didn't work with us. I could have predicted it because the nature of the offering and the marketing was very weak, even though they spent a lot of money on it, right? We were not involved and I had no way. I interviewed the CEO for my Forbes column on his company, but he was, you know, he wasn't able to do anything. He wasn't the decision maker on that offering. It was it was being handled by others. So I couldn't help them and they weren't listening anyway. So they didn't make enough money in their raise to list on the NASDAQ. They listed on the OTC. They're doing better now. They've raised more money. Their market cap's 54 million. You know, that's not a big, so that was a challenging one. Okay, so I'm gonna move on now. There's been 11 altogether. There's been a while since we had a Reg A plus because one company poisoned the well by misleading the SEC, and the SEC shut them down, demoted them to the OTC, accused the insiders of insider trading, and that put red faces on everyone, especially on Reg A plus. I wish they'd done what they did as an S1, in which case it wouldn't have put a black mark on Reg A plus IPOs as it did. But just my company, have enough hot companies that want to do Reg A pluses that I know there'll be some neat new Reg A pluses coming soon. So that's good. And once we get them going again, the momentum will rebuild. Okay, when not to list. I just want to touch on that because there's a lot of companies I recommend do not list on the OTC, do not list on the NASDAQ because of the vulnerability to naked shorting and because the company doesn't have enough news events or the internal culture established or a strong enough CFO to set expectations conservatively and then beat them. Right? It's seriously difficult to do that. It's a lot of work, and it does take revenues and profits as well as, you know, intelligently done reserves and a lot of very careful communication to the investment community, which is seriously difficult to do for a lot of companies that are early stage. They don't have enough going on yet, right? So it's asking for trouble to go out and list on any exchange when you don't have enough substance or a culture and readiness and enough resources internally dedicated to supporting the engine that is the public markets that requires a lot of attention, okay? So don't take it lightly. This business, I can't believe the SEC allows brokers to put naked shorts on stocks. You know, private investors can't, right? You have to have borrow, but brokers can do that all day long. They do. Crucifies companies. That's why there are so many, not the only reason, but it's one of the main reasons there are so many broken public companies out there with penny stocks and worse, right? Okay, excuse me while I go to the next page. Oh, yeah, okay, good. Timing, yeah, good. We're about on schedule. Post Reg A plus liquidity. Obviously, you can list on the OTC markets, even on the pink sheets, and you can list on the NASDAQ. But you heard what I just said, right? So, you know, don't, but yeah, I'll stick to my sequence because I know I've got that coming up later. The good thing here is that it's been mooted for a long time that there will be aftermarket places to list your securities for Reg A plus offerings. They are actually coming out real life. Later this year, September, October, there will be actual Reg A plus secondary markets where no naked shorting, it's just buying and sellers, buyers and sellers, that's all it is. And the one I like the best, they require these things, at least 2,000 investors, and you know, any sizable medium and up Reg A plus offering will have more than 2,000 investors very easily. And monthly management financials, not audits, but management financials reported monthly. And initially, they're not going to charge a listing fee, but they'll charge one once they've done it for a while and got momentum. So that's it, right? That's pretty damn good, because what have you got? You've got actual liquidity for your investors on a limited scale, and depending on how good the marketing you're doing on an ongoing basis is, but not depending on, not worried about naked shorting, you can support the enthusiasm in the market so there'll be enough buyers for your sellers. And that's a lovely thing, right? So keep marketing, keep promoting the company. If you're going to do more Reg A pluses, that's automatically going to support the buyer market in the aftermarket, right? Something which you may not be aware of is that once you've completed the Reg A plus, even if you don't list, this is where it's more surprising. If you don't list, every security owner in the company becomes liquid as a result of the Reg A plus. So after the first 6 monthly management financials, this is a non-listed Reg A plus, right? So once a year gap audit after you've finished your raise and during, and 6 monthly management financials. This is not a big onerous burden. So let's say you just completed the offering, and 8 weeks later, it's time for you to produce your annual audit, US GAAP level. You produce it. All the insiders have approximately a month in which they can sell their shares or their preferred shares or whatever securities you have in the company, unless you lock them up, right? So clearly, in some cases, you would want to lock them up. But where do they go? They can go to the Reg A plus aftermarket to trade them. Now, what that says is the volume, the liquidity will be modest, if not very, very little liquidity. And the downside for 10% and bigger owners of shares, investors in the company, and the founders, you know who they are, you guys are familiar with these concepts, is that you're limited to 1% of the float. So if the float is microscopic, you can sell a microscopic amount in that window of time, right? So it's in your interest to build aftermarket liquidity on that market would be my recommendation, because it's a very good way to go without vulnerability to the naked short side that we see, that I've described in great detail here, or some detail. Okay, so that's, but the fact that everybody gets liquid, that's pretty cool. And investors who are that have less than 10%, they're not restrained by, oh, you just did an audit. They're able to all day long, all year long, sell without a 1% restraint. So your long-standing investors that own less than 10% positions in the company, they get liquid, right? It's really good, automatically, because you completed your Reg A plus. No listing on some major exchange, although, all the caveats stated there. Okay. Mistakes to avoid: setting a minimum escrow when you didn't have to. Please don't do that, because it's so hard to reach the number and you have to spend all the money. I mean, really, it's so expensive to reach that minimum. A low maximum raise. One of the lovely things about Reg A Plus is that you can adjust the share price while you go. So let's say you need 12 million and you set a maximum of 12 million. Well, we might get lucky for some reason, or it may be a really compelling offering and we hit 12 million unusually quickly. And it's like, oh, we could have raised more at a higher valuation. We locked ourselves out of that by having a max of 12 million. Don't do that. Set it to 50 mil. Give yourself the flexibility to up the valuation, do a share split, do what it takes, and then go to the SEC with that. They don't judge the merit of the valuation or the merit of the company. They're looking at the legality of it. And that filing, all you do is a share split, it will go through the SEC, I'm told, relatively quickly, like 3 weeks. During that time, you're paused, but then you go live to raise a lot more money because you can and you wanted to manage dilution. That's a good thing. Very nice thing about Reg A Plus. So having set the maximum to 50 mil is your business. Do what you want, but that's one of the things I would say is a mistake to avoid, limiting yourself with a low maximum. Don't do tier one, it's a waste of time. It's too difficult to get the state's involvement. Many of them require an audit anyway, and that's the primary reason people don't want to do a tier two, is to avoid having to do an audit. Many of the states are merit review, where you've got a bureaucrat deciding if your company's good enough for their state's investors, right? That's a non-fun place to be, and they're really slow, et cetera, et cetera. 4% of the money raised in 2019 in Reg A Plus was tier one. It'll be less in 2020. Don't do a reverse merger, because there may be some rare exceptions because your company is absolutely compelling, in which case then do a reverse merger as a convenient way to get liquid, get public. That's fine. But the companies that are approaching us that need to raise money, don't do a reverse merger, because you've got to satisfy the shareholders in it, whatever, by some means or another. Usually you didn't pay much, so they're still shareholders. You got to make sure that, suddenly it's a world of hurt. There's a lot of reasons why it's a bad thing. We are working with a company right now that did a reverse merger thinking that would make it easy to raise money, which it does not. And he's now adjusting his Reg A Plus, and he wishes he hadn't done it. If he could undo it, he would. So bear that in mind. I can't go into excessive detail right here. Time. What's the time? Come on. Oh, there it is. Yeah. Okay, so reverse merger. It isn't a 2-year audit if your company only existed for 6 months, but you're not going to you can't list on the NASDAQ without 2 years of history, actual history. You can't take a company that you parked and has nothing ever happened in it 6 years ago and then use that as a NASDAQ listing company, because they'll look for the actual numbers, they'll look for actual history. And there isn't any, then you can't list. You have to have a 2-year history to list on the NASDAQ. But to do a regular Reg A Plus, then you just need an audit that goes back 2 years or less if the company's newer. Mistakes to avoid: make sure your company and the deal you're offering is going to fly, for Christ's sake. We can do a test with you. We figured out newer, better, faster ways to do that. In some cases, we've gone live with an offering because we thought we were confident with the pitch, discovered it wasn't flying, and then we'll create multiple offering pages. Well, the agency creates them on our platform, multiple offering pages, all of which are taking money, all of which are flowing the money into escrow or to a segregated account, but different ads for those different offering pages to figure out better messaging, right? So we'll do that if we need to after the start, but if it was always going to be a duffer because it's a lovely company, but we'll never be able to communicate it, let's not do this at all. Or if the substance is there to support it, do a debt offering where people are investing in the high interest rate you're paying. But make sure we're doing the right thing. Don't just do it for the sake of it. Don't set a high per investor minimum, because when these folks that we bring in via social media advertising arrive, they were doing something else, right? but the ad brings them in to look, and they're checking it out because it is interesting to them for some reason. We've got about 7 or 8 seconds to get them to stay. So if the minimum is too high, they'll leave. At this point, it's ultra casual. They were doing something else, right? And if it's too high a minimum, it's not play money, they're gone and they'll never come back. You have the minimum low enough to say, I could play with this. I could put a token amount of money into this and see how it goes. Now they're sticking around for 30 seconds, and we got to make that compelling enough that they start to invest or they stay for 3 minutes, right? Those are the obvious mistakes. I'm now open to answer questions. I don't know how many are, but I'll be pleased to look at them. Oh, geez, where are the questions? Scroll down, scroll down. Sorry, guys. Yeah, we are recording this. Advantages of Reg A plus over Reg D. It's easier to attract the attention. The marketing costs are lower. It's easier to reach Reg A plus investors for the right kind of offering. Reg D is easier to start, costs less money to start, it's quicker to start because you don't have to file and ask permission from the SEC. That's a lot. Those are a series of, that's a big deal. Costs less money to get ready, and it's quicker. So in 4 weeks, we can be live with a Reg D and good marketing going. But, it's difficult to get the attention of accredited investors, and they're cynical for good reason. So, only some cases, I'll recommend you for it or against it, depending on the nature of your offering, right? But it's hard to get Reg D investors unless it's a compelling message. They want to make money. They're not doing it for the optimism reasons that we see in Reg A plus. Yes, once qualified by the SEC, you have a year in which to raise the money. You can pause it early. You can pause it. You can reopen it, and you can cancel. You can finish it early, but it's a year, and you can renew it. But it's a new filing. You'll pay the attorney a bit less if it's the same offering style, same security, etc. But you start ahead of time. If you want to have it without really any long break, you start the second one before the end of the first one, so it's ready in time. Which is the best platform from an economical standpoint to list on, which exchange of, NASDAQ's the real market, right? If you've got a company that has enough substance to support itself, that's the place to be. I wouldn't go to the OTC markets because it's so hard to gain liquidity there to support the share price. But they are there, they're easier to get into, they cost less, right? I think it's 12K or 15K to list on the OTC QB, so it's less cash expensive, but that's only a small piece of the whole mix of variables here, right? Comparing two options, doing a rate. Yeah, so, comparing two options, doing a Reg A plus to raise money first and then post the listing on the NASDAQ, as compared to a reverse merger with the NASDAQ shell, then raise the money as a public company. Well, most of the shells you can buy have stock that's, a penny stock, right? That's a problem. It has a bankrupt history. That's a problem you need to earn your way out of. Typically, you've got a lot of shareholders that want their pound of flesh. So you've got to do something different. You don't really, in many cases, it isn't a good idea to offer common stock. If it's a shell that has some, the trouble is there are so many caveats, but generally speaking, penny stock, so do a new security, not the security that you got this company public for. So you're public with something you can't really do much with in many cases, in my view. But when you have mega companies, like some of these electric companies we've seen, where they're able to use a SPAC or a shell to go public, they're different stories because there's so much interest. Is it possible to have some docs in Italian language? Well, the filings all have to be in English. And we have automatic translation in my website. So look at my website, Manhattan Street Capital, see the logo behind me. And if you click Italian, the whole site's in Italian. Yes, you can raise money in a Reg D and a Reg A plus simultaneously with different terms, yes. Different price, different preferences. 14 million sales or cap, not sure what you mean, but typically 14 million raise is the sort of zone you need to list on the NASDAQ. More is better, but you know, that's sort of the minimum. Typically there'll be some exceptions. Well, at the moment, because of the the market being so hyped up or so hot because of the Fed support, there are some SPAC companies which are essentially a brand new blank check. They're a shell company that's new and fresh that hasn't been used yet. What's the name of that electric company? I can't remember it, but there's a electric truck, Nikola. Yeah, Nikola, they did that. They did a transaction. You know, but we're talking very, very high valuations, very nice market. You know, you should just go and do it straight away. That's fine. It works for them in those situations. You're raising mega bucks. Reg A plus isn't the appropriate instrument. Yeah, it's a statement from Lloyd, and I agree. Can you still offer the man invested? I don't understand the question from Dr. Wild One. If you can resend that, I don't understand what you're asking. Yeah. Okay, just reading down. Some good statements, some useful statements. Thank you. Yeah, I hope you are enjoying this. Judging by the number of questions, some of it's relevant at least. I enjoy doing this stuff, I do, but particularly if you're enjoying it. If I'm doing it and it's duff, then why would we do this, right? I got to think I know more than the audience does, then I enjoy it. Yes, direct listing is not brand new. That's been available for some time. And I'm looking forward to doing Reg A plus direct listings. It's just a superb animal, you know. I'm looking forward to doing that. I really am. Just a matter of time, right? And then when we do the first one, there'll be many others, I don't know. There'll be others that follow. That's one of the reasons we're not a broker dealer, is that we can do a lot more things. We can partner with underwriters to do an IPO. If we were a broker dealer, FINRA would ban us from the transaction, because they would say the commissions that we would charge plus the commissions that the underwriter charges is excessive compensation, and you can't do it. Whoa, can I provide a list of companies that have utilized Reg A plus? Go to Edgar, the SEC. We don't have a list of all of them. There's loads of them at this point. We produce reports on the new numbers and things on a regular basis. But if you'll send me an email, I'll send you some info on that. What if trying to raise over the tier 2 limit, is it possible to do more than one Reg A plus tier 2 offering? Yeah, where that's been done successfully multiple times is by Fundrise, where they have a new entity doing each entity doing its raise is separate. It's an LLC and it's separate from the other ones, and they all share one manager. So it's one manager orchestrating it and making a lot of money. And they've raised over $900 million at this point in Reg A pluses, just in Reg A pluses, multiple parallel offerings. So it's possible in theory to do that for a non-real estate company, although no one's done that yet, right? So you set up a management structure, and then you set up an entity that does a Reg A plus for this, and another one over here that does a Reg A plus for that. That should work, but nobody's done it. It's been done in real estate only so far. I would say that at any given time, oh boy, there's approximately 8 companies get qualified per month by the SEC. So that gives you an idea. Not to say that all of them should, but that's the number that do get qualified per month. So what is that? It's like 100 a year get qualified. So that gives you a sense of it. In 2019, we have this whole report on my website. You can go look it up in the blog and in the news. In 2019, Reg A Plus raised slightly more than $1 billion. The total number of total offerings raised were a bit more than $1 billion. Of that, 650 million was real estate. The average was 20 million. And if you count only tier 2 offerings, the average was higher, 24 million or something. Most of the big raises were real estate. That's 41% up on 2018. So not bad. And this year will be up on 2019, but I don't think it'll be up 41%. I think more like 20%. There are no particular minimum revenue requirements for a Reg A Plus IPO. It's not about revenue, it's about the overall attractiveness of the company, right? You can have a company with no revenue right now, but they're gonna kick ass in an amazing space like a biotech. And you can have a company with substantial revenue that's so boring, no one in their right mind would touch it, right? We had a company last year or 2 years ago that wanted to go IPO, but they were experiencing, 0.5% a year growth, 1% a year profit, dead, boring business. Not a really good candidate for an IPO. No. The list on our site, we're only, we're one player in the universe of Reg A Plus, and we've got offerings we've done that aren't shown. If you send me an email, I'll send you the metrics, and I'll also send you a document that describes the more significant deals that we've done. But if you want to count them all, my God, it's going to be a long time and a long effort. I can send you a spreadsheet that lists them, probably. That's what I'll send you, I suppose. Send me an email about that. How many hotel companies are using Reg A Plus? I don't know that number. I don't know that number, I'm sorry. I know it's being done, but I don't have an answer for you. Big market for solar and battery projects because Reg A Plus investors care about the environment, right? Individuals care about it, so they'll put the money where their mouth is and invest. Very much so. And I want to do companies that will reverse climate change, and I want to do companies that will have virus solutions for us, because my God, we need them, right? Vaccines and other medicines. Yeah, well, Nicola and Fisker are special cases. I'm not saying don't ever do a reverse merger. If I said that earlier, I was wrong. I'm thinking in our zone, in companies in our zone of interest. If you're going to do it, make sure you know what you're doing. That's all. I'm not trying to diss reverse mergers altogether. Yeah, an offering can have a minimum of 500 per investment. So far, we've had companies doing 300 up through 600. That's the range we've had. Yeah, there'll be a recording within a week, less probably. Yeah, so, Chuck asks, looking for a clean public shell as I'm a startup and wish to do a Reg A Plus tier 1 for 40 mil. Well, you can't do 40 mil in tier 1, it has to be tier 2. And I wouldn't use a shell. This wouldn't do it. To my mind, for that, you should do a Reg A Plus itself and don't do the shell part. If you want to email me about it and have a discussion about it, I'm happy to. Yeah, Nicola is neat, huh? My 15-year-old son told me about that one, and I invested in it. Who knows how it's going to actually perform? There's a lot of buzz. Look at the price umbrella that Tesla has created, right? It's absolutely astounding. I was in a venture fund that invested in Tesla. So I had Tesla stock from the get-go. Stupidly sold it, though. Could you raise money by creating a REIT? And could it cost less than a Reg A Plus? Well, I don't know how you would raise the money. I mean, Reg A Plus would be the best way to get the REIT funded. I don't know a better way to raise the money. How large a network does Manhattan circulate? We have 60,000 members. Our list isn't as big as it could be for two big reasons. One is that we don't take, for all the offerings that are live on our platform, they don't get into our list. They don't get into our list to promote a new offering because they're off limits. If you do a deal with us, while your offering is live and until it's finished, we will never do anything to promote another offering or allow other companies to promote themselves to your list, right? So we don't touch them either. So our numbers are much bigger than I'm saying at all times because there's a whole large number that aren't ready yet, right? When those offerings finish, then they'll be our members and we'll market to them. We are respectful of our lists and we don't abuse them. So that way they're pleased to hear from us and we get more value out of that than otherwise we would. And we're selective, right? We could have done a hell of a lot more deals than we've done, but I don't want to do, you know, for one reason or another, we didn't want to do them. So that's kept our list and smaller, but a happier list, I think. Can we be the sponsor for the direct listing on an exchange, or we still need DTC? DTC eligibility is needed anywhere, you know, transfer agent anyway, like computer share or vStock, yes, all of those are needed. You don't need a broker-dealer sponsor per se to do a direct listing. You do need to get 3 market makers lined up, but if the company's hot, that's trivially easy. And that's part of the process of dealing with NASDAQ. That's where they come in handy. Thank you. Hope you have a great day. Hope to hear from you at some point in time with some compelling, exciting company that we can do great things with. Have a great day, guys. Bye-bye.